Good afternoon. We'll start the thing. Hope all are here. Last week, okay. Last week, someone asked me a question. SLFR. Who asked that question from me?
Karani, sir.
Okay. Right. We have three rates. You can see the board, right? Clearly. Pain on it or board?
Yes.
Board pain on the?
Yes.
Oh.
Okay.
Yes, sir.
Right. We have three rates. SLFR, SDFR, bank rate, right? SDFR is standing deposit facility rate. Standing lending facility rate, and bank rate is bank rate, right? What does this mean? When bank has excess cash at the day end, you can deposit that cash with central bank. This facility is called SDFR, which is currently at 4.5%. Right? අපිට දවස අන්තිමට අපේ සල්ලි ප්‍රමාණය වැඩි නම් liquidity වැඩි නම් අපිට පුළුවන් central bank එකේ ඒ සල්ලි ටික deposit කරන්න overnight, but it is very short. Tomorrow you have to take overnight market. We can deposit this, like we have enough money, we don't have anyone to lend also. It is like this. Right? PASA, TMD, term loans, money market, and capital. This is the way banks are funded. So this is money market. We take, in order to bridge our funding gaps, we take short-term money. අපිට අද සල්ලි නැත්තම් අපිට money market එකට ගිහලා borrow කරන්න පුළුවන්. Right? Similarly, when you have enough deposit and you don't have anyone to lend, you can go and deposit that money in the central bank. That is called standing deposit facility rate. Then similarly, when you don't have money, you can borrow from central bank for very short overnight. That is called standing lending facility rate, which is at 5.5% at the moment. Right? So those are day-to-day excess liquidity you can lend and borrow. When you are borrowing under this rate, you have to lodge treasury bills with central bank. Right? Whenever you are borrowing from central bank under SLFR, you have to SLFR, you have to give your treasury bill portfolio to central bank. Then we have bank rate. This is, in our history, no one has used this bank rate. This is lender of last resort. And this is the lending central bank will do to a bank when there is a liquidity crisis in the bank. Under this rate, which is 8.5, you can borrow from central bank short term, but it is only when the bank is finding a liquidity crisis, lender of last resort. Right? That is the bank rate. Is it clear?
Yes.
So I answered your question, right? So
Thank you,
these are
sir.
basically policy rates of the central bank. Okay. Earlier, about was called repo and reverse repo rates. Right. Let's start the session now. Can you see the presentation? Can you see the presentation?
Yes.
Right.
Yes.
Okay. We were doing this presentation. Okay. We were here. Right. Right. We were discussing what is the credit policy. Right. We take the lending timeline. We start with the origination. Then we go through evaluation. Then we approve. Then we disburse. Then recovery, and then go for final recovery or legal action or foreclosure. Right? This is the process of lending. Right? Prior to approval, this side, pre-sanction monitoring. From here to this side, it is post-sanction monitoring. Right? From the date of origination to the last date, you have credit, documentation. From disbursement towards this side, credit admin function, CAU, right? Then somewhere here on the recovery, we have early warning signals. So all these things are covered by an umbrella, which is called credit policy. This can be segmented umbrellas within that. SME, leasing, corporate, retail, like that. Then within this, we will have smaller umbrellas like project loans, working capital loans. Like that, we have different smaller umbrellas. So on the credit process, the overriding direction, high-level lending direction is called credit policy of a bank. The owners of this credit policy is the director board. But custodian of this policy is the risk department. Risk department has to prepare the credit policy, that is the direction, guidelines of lending, high-level guidelines, with the assistance of the business lines. Risk department can't prepare a credit policy alone. It has to be in conjunction with business lines as well, right? So they prepare it, but board of directors needs to approve it. So when it is approved by board of directors, it is the direction given by the board of directors, right? That is called credit policy. So in this process, prior to approval, you have something called credit review. Then after disbursement, you have something called loan review mechanism. Credit review and loan review mechanism, both are risk functions. Risk functions. So credit review, what does they do? Before approval, they will try to put the credit into perspective. Like if we want to give a POD, they can come and say no, structure should be changed to a term loan. When we want to give a term loan, they also can say no, it can be a short term. You can take security. Like that, they can give suggestions for the approval. But LRM, loan review mechanism, what they do is they will find the defects or the trends of the approver. Like they will come and say, you have not looked at the crib. Customer was in crib when you approved. You have not given the proper structure. Your covenants were bad. Straight finger pointing to approving authorities. Right? Metana mamme pennanne ape credit process එක. From ape customer කෙනෙක් ඇවිල්ලා කතා කරන්න පටන් අරගෙන එතන ඉඳන් approve කරලා disperse කරලා collection ඉවර වෙනකන් යන process එක තමයි මේ මම ඇන්දේ. එතකොට මේක override කරන guideline එක තමයි අපි credit policy එක කියන්නේ. policy එක හදන්නේ risk department එකෙන්, හැබැයි policy එක approve කරන්නේ director board එක. So then director board එක තමයි policy එකේ අයිතිකාරයා වෙන්නේ. credit policy එකෙන් තමයි අපිට top level lending guidelines දෙන්නේ. So it is very, very important. If something goes wrong, central bank will catch hold of the directors first, then only they will come behind us. Right? So that is credit policy. So credit policy can be, right, this credit policy formalizes high-level lending guidelines that the bank needs to follow in granting credit. So credit policy is similar to this, a family where father, mother and the children, so they cover the main guideline, protecting the family, leading the family, providing for family. That is the overall guideline. Under that umbrella we operate. So it is similar to our own life. Then we will go to this one, 5 C's of credit. So what are the 5 C's? Is given here. Character is the most important C when you are lending. The willingness to pay. character indicates the willingness to pay. So our aim in evaluating is to find the character first. So you can check the character, financial character with the crib, right? Even by looking at who are the associates of this person. Are they telling us lies? Or even how they treat their own employees or suppliers or buyers. That also indicates the character of the owners. When you feel the character is bad, we should never lend. Willingness to pay is the key function of character. So normally we look at the crib. If the crib is very bad, we should not touch. There are green color cribs where you feel like giving it even without security or second way out. Then you have cribs where you have yellow color, that means 1 to 60 days arrears. Then when it goes bad, it is red. Customer can go to crib, but the most important thing is once he goes to crib, he has to come out of it. අපිට ක්‍රිබ් එකේ හොඳ මිනිස්සු ඉන්න විදියක් නැහැ. මින් එක්කෙනෙක්ගේ මොන හරි ප්‍රශ්නයක් හන්දා ලෝන් එක ගෙවන්න බැරි වෙලා මාස 3ක් ගිහිල්ලා එයා ක්‍රිබ් එකට යන්න පුළුවන්. NPL වෙන්න පුළුවන්. හැබැයි එයා ඒක රීෂෙඩියුල් කරගෙන ගෙවනවා නම් දිගටම අර ක්‍රිබ් එකට ගියා කියන එක ප්‍රශ්නයක් නෙමෙයි. හැබැයි අපි ක්‍රිබ් එකට ගිහිල්ලා දිගට මේකේ ඉන්නවා ගෙවන්නේ නැහැ. අහුවාම වෙන වෙන උත්තර දෙන්නේ. එහෙමනම් ඒ වගේ අයව අපි ගන්න හොඳ නැහැ. Right? Or some basic answers are bank didn't come to take the post-dated checks. I used to give post-dated checks and the financial institution did not come to collect. Paying is the responsibility of the borrower. Banku avat natat, they need to know how to pay. They have a responsibility of paying. So establishing character is the critical requirement. Then we go to capacity. It is the ability to pay. Right? Capacity is the ability to pay. How much can they pay? How do we calculate this? We use a formula called debt service cover ratio for long-term loans. Short-term loans, we use something called interest cover ratio. Hope you have drawn this. Do you want time to draw this? Because it is not in the handout. Okay, can I proceed? You can send me a text. I'm watching the text box as well. No need to on your mics if you don't feel like, or you can on the mics and let me know. Do you want time for this? Deshan, you said yes. Do you want time or can I proceed? Someone has told you can. I can proceed. If even one wants time, I'll give time. Right. So silent. I'm going ahead. So right. So we were talking about capacity. You can see this. Right. So it is debt service cover ratio. which is equal to profit before interest and depreciation minus tax divided by term loan capital, interest, term loan, short term loan, plus, please.
So can't see the board.
Sorry?
So cannot see that side of the board.
Okay. Sorry, I'll erase that. Capacity, DSCR, profit before interest and depreciation minus tax divided by capital, term loan, interest, term loan and short term loans, plus lease rentals. Right? This is called debt service cover ratio. For long-term loans, we use this one to find out the capacity to repay. Then for short-term loans, we calculate something called interest cover ratio, which is profit before interest and depreciation minus tax divided by interest, term loans plus short term. Right? So these are the two ratios we will look at when we are talking about the capacity, ability to pay. Right? I will explain in detail when I'm doing financial statements on these figures. Right? But for the time being, you just remember, for short-term loans, we use this, and long-term loans, we use this one. Then capacity, then we work out. Third C is capital. Right? Third C is capital. Capital is the money the owners has invested in the business. The money owners has invested in the business. Why do we need capital? Due to two reasons. First one is to get the commitment. අයිතිකාරය සල්ලි දැම්මේ නැත්නම් බිස්නස් එකේ වැඩිම සල්ලි බැංකුවකින් ඇවිල්ලා තිබ්බනම් බිස්නස් එක බැංකුවට ඕන හන්දයි කරන්නේ. මට නැති වෙන්න දෙයක් නැහැ. Right? So commitment is, in order to get the commitment, they should have invested their own money. Then the second one, when capital is high, repayment ability will be higher. Why? Business won't go like this. Business සාමාන්‍යයෙන් මෙහෙම fluctuate වෙවි යන්නේ. හරි? දෙසැම්බර් මාසේ වැඩි, ජනවාරි පොඩ්ඩක් අඩුයි, පෙබරවාරි වෙනකොට අඩු වෙලා යනවා, ආයි මාර්තු අප්‍රේල් මැයි වැඩි වෙලා, ජූනි ජූලි වෙනකොට අඩු වෙලා යනවා. එතකොට අපේ මාසෙකට ගෙවන වාරිකය මෙන්න මේ වගේ කමිට්මන්ට් එකක් වුණොත් මේ අඩු වෙන වෙලාවට මෙතනදී යාට ගෙවා ගන්න බැරි වෙනවා. මෙතන ඕල්මෝස්ට් බැරි වෙලා. හරි. but එයාගේ business එකේ එයාගේ සල්ලි වැඩියෙන් තියෙනවා නම් අපේ මාසෙකට ගෙවන ගාණ අඩුයි. එතකොට business එකේ drop එකක් වුණත් බැංකුව ගෙවන්න එයාට හැකියාව තියෙනවා. Even there is a drop in the business, if your monthly commitment is low, then they will be able to service. Otherwise, what will happen when the business turn down, they will not be able to pay. ඒගොල්ලෝ pay කරන්න බැරි වුණාම ඒගොල්ලෝ arrears යනවා. ඒක හන්දා තමයි දෙවනි requirement එක repayment ability. Capital එක වැඩි වුණාම when the money invested by the owners are high, your repayment ability will go up. Why? Then out of your profits, the amount you need to dedicate to repayment is low. Right? ඒකයි අපිට capital එක ඕනේ වෙන්නේ. Then the fourth C is condition. Right? Fourth C is condition. Condition is not the conditions we put for loans. Condition is the macro environment. Like if you are going to give a facility to a hotel these days, we have to look at the tourism industry, travel and leisure industry, whether it is good or bad. Will there be a future? What will happen to the industry? Right? If someone comes to our hotel industry at this moment of time, we may not give. Even for construction, yes, we are having doubts whether we will get the repayments. Vehicle imports, if someone comes, no, we are not giving because it is restricted. So that is the macroeconomic condition of the industry my customer is in. That is the condition. Then fifth C is the collateral. That is the security. If everything goes bad, how can I collect my money? If everything goes bad, how can I collect my money? I need to have some sort of a fallback situation. That's the security. So 5 C's of credit is character, capital, capacity, capital, conditions, and collateral. Some people say 6 C's of credit. That's also there. The sixth one is cash flows. Whether this business generate adequate cash to cover the commitment. Cash flows. That's 6 C's. Normally we say 5 C's. 5 C's are character, capacity, capital, conditions, and collateral. Then principles of lending, right? The principles of lending, we have 9 principles here. Safety. The most important at first principle is the safety of your money. Why? This money does not belong to us. It is the depositor's money we are relending. So whenever you are lending, if you have any doubt of the repayment of a borrower, you should never lend. If you don't give your own money to a borrower, don't give banks money. The safety of lending, safety of money is the key principle. සල්ලිවල ආරක්ෂිත භාවය තමයි කීම ප්‍රින්සිපල් එක lending. අපි හිතනවා නම් කොයි වෙලාවවත් අපිට මේ සල්ලි ටික අය කරගන්න බැරි වෙයි. එහෙම නැත්නම් සිකියුරිටි ගුණලා තමයි අය කරගන්න පුළුවන් වෙන්නේ කියලා ඒ වගේ අවස්ථාවක ණය දෙන්න යන්න එපා. ඊට පස්සේ එන්නේ liquidity. ද්‍රවශීලභාවය. How quickly and how easily can we collect our repayments? Right? There are two things. Credit risk and liquidity risk. Right? credit risk කියන්නේ දවස් 90 පෙන්නට පස්සේ බැංකුව මේ සල්ලි මට හම්බෙන එක නෑ කියලා හිතන්න ගියාම තමයි credit risk එක. Liquidity risk කියන්නේ හරියට નિયમિત දවසට ගෙවන්නේ නෑ. දවසක් දෙකක් තුනක් මාසයක් පරක්කු වෙලා හැබැයි ගෙවනවා. ඒ වගේ අයට අපිට liquid risk එකක් තියෙනවා. අපිට අවශ්‍ය දවස සල්ලි එන්නේ නෑ. අපිට අපේ cash flow එක plan කරගන්න බෑ. We can't plan the cash flow because they are not paying on time. Right? So we will have to borrow from other sources in order to get our liquidity. So liquidity we have to consider. Third one is profitability. Profitability of a business. Of the business. Banks are not charity. We have to sustain our banking business and we need to generate profit. So from any customer, the transaction should be profitable. Right? If it is not profitable, don't do it because you have to pay interest to your depositors. You have to pay that. You have to recover from the borrowing customers and pay to the depositing customer. Right? We can't generate money. We can't print. It is from the income we earn by lending, we pay the deposits. Portfolio, profitability. Then third one is spread, balanced portfolio. I think last week I discussed about concentration risk. Right? එකම දෙයකට වැඩි වියදම් සල්ලි යොදවන්නේ නැහැ. දැන් උදාහරණයක් විදිහට හේලිස් ගෲප් එකට අපිට සල්ලි දෙන්න පුළුවන් ප්‍රමාණයක් තියෙනවා. ෆීනික්ස් ගෲප් එකට සල්ලි දෙන්න පුළුවන් ප්‍රමාණයක් තියෙනවා. එහෙම නැති වුණොත් අපේ බුක් එකේ වැඩි හරි එතනට ගියොත් ඒ ගෲප් එකේ මොන හරි ප්‍රශ්නයක් ආවොත් බැංකුවට ප්‍රශ්නයක් වෙනවා. ඒක හන්දා අපි concentration risk කියන එක ගැන ගොඩාක් බලනවා. එතකොට දැන් උදාහරණයක් විදිහට නිගම්බු බ්‍රාන්ච් එකේ වැඩිම හරිය ලෝන් වලට දීලා තියෙනවා නම් වැඩිම හරිය දීලා තියෙන්නේ හොටෙල්ස් වලට නම් ඒගොල්ලෝ concentration risk එකක ඉන්නේ. Tourism industry is bad because of that part of the major part of the portfolio is non-performing. Then branch will not get income. Right? So concentration risk is name concentration, even at the sector concentration. Mamar Haley's group again name concentration. Tourism industry again sector concentration. Right? Egahanda koi වෙලාවකවත් එකම ಜಾති අයට විතරක් lend කරන්න හොඳ නැහැ. එක එක products එක එක ಜಾති අයට දෙන්න ඕනේ. Then the purpose. What purpose are we lending? Is it a legal purpose? Illegal purpose? What is the purpose of lending? Right? Speculative purpose? Like in Sri Lanka, we can't lend for weapon manufacturing, prostitution, pornography. We can't lend. But there are some countries where they can lend. But here it is considered to be illegal. Right? So purpose of lending. Then the end use. And under the purpose, we have consumption, we have commercial, and we have speculative. Consumption lending is when the use of money, end use of money does not generate income again. It is consumption lending. ගයක් හදන්න වෙන්න පුළුවන්, පුද්ගලික පාවිච්චියට කාර්යයක් ගන්න වෙන්න පුළුවන්, එහෙම නැත්නම් TV fridge ගන්න වෙන්න පුළුවන්. ඒ වගේ lending consumption lending. If the money is invested to a grocery shop and it will regenerate money, then it is commercial lending. Speculative lending is, right, I'm buying a property because you want to increase the market. Short term in buying and selling. Aiming increasing the market prices. That kind of thing is speculative. So purpose we should know. Speculative lending also bank should never do. It is risk, high risk. End use. the final use of the money. I'm giving money to construct a warehouse. Has that money gone there and the building warehouse has been constructed? You have to be very careful of the end use of the money. Then it is need-based and need-based financing. We should not lend, we should not overlend or underlend, right? And we should not lend thinking about the security. If you think that you have to recover through security, don't lend. That is the third, final one. Not the final, prior to that. Valid viability base instead of security base. You have to lend based on the viability of the project. If you think that customer has to pay only through liquidation of security, don't lend. හොඳ බිල්ලිමක් දෙනවා ඒක හන්දමන් සල්ලි දෙනවා බැරි වුණොත් සිකියුරිටි එක ගන්නවා එහෙම හිතලා කොයි වෙලාවක lend කරන්න එපා. The money you are giving, it has to be productive purpose and the business should be able to repay that money. That is the viability of the business. Need-based financing is don't lend more than they need or less than they need. Lend the required amount. Then the owner's stake, that is again the capital. We need the customer to invest money in a business. Right? These are the 9 principles. Sometimes we have a 10 principle, that is the government priority. Currently, dairy industry is a government priority. Then SME sector is a government priority, right? So safety, liquidity, profitability, spread, purpose, end use, need-based financing, viability versus security base, own stake is the key principles of lending. I think details are given. Yeah, it is here. So you can go through later. Details are given at the last slides. Right? Anyone has any question? Does anyone have a question? Right. Lending proposition means customer, always a customer should come and ask for the lending or the borrowing proposition. When a customer comes and asks for a loan, bank should decide whether to respond positively or not. So when the loan request comes, it can be acceptable as it is, or it can be adjusted and accept, or you can reject it. That is the බරෝ තමයි ඇවිල්ලා අපේ සල්ලි ඉල්ලන්න ඕනේ. බරෝ තමයි කියන්න ඕනේ මට මෙච්චරක් දෙන්න කියලා. එතකොට බැංකුව දැනගන්න ඕනේ දෙනවද නැද්ද කියලා තීරණයක් බරුවට දෙන්න. Then බරෝ ඇවිල්ලා අපිට amount එක මොකටද සල්ලි ඕනේ කොච්චර කාලයකටද ගෙවන්නේ කොහොමද කියන එක කියන්න බරෝ දැනගන්න ඕනේ. Borrower should be able to tell us what is the amount he need, what is the purpose he need, and how he is going to pay, and කොච්චර කාලයකටද එයාට how long he needs to repay. That has to come from borrower. Sometimes borrowers come and how much can I get? You give me 5 million, I'll do this. You give me 10 million, I'll do this. No, you should never put yourself into that trap. Customer should have a firm idea what is he going to do, what is the money he needs, and how long he needs to pay, and how much he can pay, and how he is getting this money. Very recently, I had a case where borrower has done a hotel. It is a huge one. 300 million money has been invested. But he can't show how he got this money. How and how he's going to repay. That he can't show. Then we could not, because of that, we could not give funding for that customer. Banker's responsibility is to do a profitable business, basically, because we are doing a business, we are in the business of lending. So when the customer comes, good projects, we should sustain our lending business. So it has to be profitable business. Always we should be able to ensure that customers will repay as agreed as much as possible. If you ever think that you can't get money from a customer, don't do it. And again, lending is a science and it is art. It is a combination of science and art. Right? Yes, now scoring methods comes in. With the scoring methods, you can look at the retail side of the lending. But when it comes to SME lending, you can't have a hard and fast rule. If you have this, we lend. If you don't have this, we don't lend. It is the experience and the exposure we get who creates us. Right? Like when a customer comes in, you need to read his body language. Right? Sometimes when I meet a customer, by their tone, I can say he will not pay. He will pay. He is honest. That even the tone we can predict. The way they act in front of us, we can predict. Right? So that is called intuition. Samara customers that is intuition. Intuition comes from experience and using the knowledge we have. Right? But the experience should come from learning and applying the principles of good lending. වැරදිලා තමයි මේ තත්ත්වයට එන්නේ. මගේ ජීවිතේ මම ඉස්සල්ලාම දුන්න ලෝන් එක එරියස් ගිහින් තියෙනවා. Right? 23 years ago, the first loan I gave 1.5 million, it went into NPL. So we learn from the mistakes. We had been discussing with customers, we had been dealing with customers. So now we can predict customers. Okay, so intuition comes, sometimes when a customer comes, this stomach burns, right? I feel a very bad, uncomfortable posture. When I feel that, I never give. I'll find a way to say no, right? I checked this with an American trainer once. Then they use a word called butterflies in your stomach, right? What they say, if you have butterflies in your stomach in front of a customer, forget about it. Don't give money. Customers like ගැටිලා වැරදිච්ච තැන් හදාගෙන එහෙම ආවහන්දා නිකන් අර ඒකට කියන්නේ මොකක්ද සිංහලෙන් කියන්නේ ඒක තේරෙනවා ඇඟට මේ මිනිහා ගෙවයිද නැද්ද කියලා වගේ තේරෙනවා මේක හොරෙක්ද කියලා තේරෙනවා. If you violate basic principles, customer will go NPA. Right? So bankers' decisions, in order to mold a credit person, it takes time. You have to apply learning and intuition will build on that. Type of borrowers, we are talking about business. Even business borrowers, we have individual people. who borrow under their personal name. Then we have sole proprietorships. That is individual who goes and register a business. So then it is a business name, but individual. So at this moment of time, the owner of the business, if it is me, Indika Kudagamage grocery, still I am fully responsible because it is just a business registration. It is not a legal entity. It is just a business registration. So the sole proprietor and the personal name comes together. I am fully responsible. Then I join hand with my brother, Indika Malinda groceries. Then it is a partnership. Again, it is only a registration, right? There is no legal entity. If a partner dies, you can't continue the business. Unless otherwise, the remaining partners are ready to take over all the liabilities of the demised partner. That is a partnership. It's covered by partnership ordinance. Then the third category or the fourth category is limited liability company. That is the first instance a separate legal entity is created. Sole proprietor, it is the human. It is the person who is behind it. Individual, the person. When it comes to sole proprietorship, though you have a business name and registration, it is not a legal entity. When you are into partnerships, again, it is not a legal entity. But limited liability company, it is a legal entity. M&I private limited. So a bank, whatever they do, they have to communicate with the company, right? You just can't tell the directors. Directors are only employees of the business. So board communication between the company and the bank is through a board resolution, right? Board resolution needs to be there in all transactions. Company is a complete legal entity. If there is a change of directors through a board resolution, the company should inform. If we are writing a letter, we have to write to the company with the attention ABC Perra director, right? If a director or shareholder dies and a company will continue to operate, right? Because company is a legal entity. But partnership, partner dies, business comes to a halt, right? Then you have companies, then you have public limited liability companies, that is where the number of shareholders are large, like a bank, or it can be quoted or unquoted. Quoted means you go and list under the Colombo Exchange, Colombo Stock Exchange. Those are quoted companies. Then on top of that, you have other companies which are not business related, statutory bodies, government institutions, government, societies, corporate society clubs and NGOs like that. You have different formats. But on the business side, we have individuals, then we have sole proprietors, then we have partners, then we have private limited liability companies. Limited liability company is a separate legal entity. Purpose of advances, you can give it to anything. Trading, housing, agriculture, industry, tourism, all those things, whatever funding requirement, you can categorize and lend. Under the small and medium enterprises, you have service industries, your manufacturing processes, in all varieties you can cover under small and medium enterprises as per the definitions I gave you. Classification of small and medium is based on the definitions I gave you on the first day. Then advances. Yes, someone wants to ask a question?
Nowadays is that limited liability company have only one directors. They are registered, no?
Yeah, you can have just a one director company. You don't need to have several directors. Even you can have a one director. Then again, director and the company are two separate entities.
Then if the directors demise, what happens for that? We are going for a legal action, no?
Yeah, then there will not be anyone.
Oh.
Right? If you have 3 or 4 people, one dies, still it continues.
Okay,
right?
okay.
Right. Then we have a type of credit facilities, direct facilities and indirect facilities. Direct facilities are the facilities where once granted, where money flows out of the bank. Direct facility එකකදී වෙන්නේ අපි grant කරේ ගම සල්ලි customer ට අරගෙන යන්න පුළුවන්. Let it be a credit card. Once you grant a credit card, customer can take out money at any time. Term loan. You grant a term loan, money can be taken out. But under indirect, there is no funding involvement. Under indirect, we take a responsibility on behalf of a customer, like a bank guarantee. If the customer does not pay, we will honor. LCs, send us the documents, we will send you the money. All those are indirect facilities. No funds will not go out of the bank under indirect. Direct funds will go out of the bank once the facility is granted. Indirect facilities, we only take a responsibility. All type of guarantees covers them. So this is a list of facilities we have under direct. Short-term loans, mortgage loans, any loan which is backed by a mortgage is called a mortgage loan. Pledge loan is a facility where we give money to the customer to buy some goods, and the possession of the goods will be with the bank. Whenever customer wants goods, he has to settle the bank and take out the goods. Those are pledge loans. Trust receipt loans, that is a loan which we grant for trading business, mainly imports. So, and even trading business, where we finance the stock. So we grant based on the trust of the customer, right? See, short-term revolving loan, bridging loans is a short period loan. Pending a final facility approval, we give a bridging loan. Foreign currency loan, export packing credit, overdraft. Export packing credit is PCL. Prior, we give money to prepare an order. That is packing credit. Overdraft is a bucket where we give a limit over and above the available balance in the current account. Right? All of these, once granted, money goes out of the bank. But indirect advances, we take only a responsibility. Bank guarantees, letter of guarantee, that is for the credit purchasers, tender bonds, applying for a tender, performance to confirm the performance, advance payment to confirm the advance payment. Retention is to take out the retention money, and maintenance is for the maintenance of a business. So under these indirect advances, we take a responsibility, no cash out. Terms and conditions when you are granting a facility, you need to have terms and conditions. How much we are giving, what is the interest rate, repayment period, short term, long term, monthly repayment or quarterly repayment, equal installment or reduce imbalance, like that. Then what are the securities, and then comes the covenants. Covenants are the conditions we put to maintain the risk level. Right. In a business, we take time. This one, risk. Normally with time, risk increases. Right? We use covenants because we evaluate the risk level here at the beginning of the facility. We want to maintain the same risk level in the future as well. So we use covenants. These are the conditions we put to the customer. Covenants are twofold: positive or negative, affirmative or restrictive. Right? Restrictive covenants, negative covenant, we will restrict the customer's actions. You can't invest more than 10 million annum without asking a bank. That is a restrictive covenant or negative covenant. You can't pay dividends more than 50% of the distributable profit. That is a risk. You can't. We restrict the customer. Then affirmative or positive covenants are we don't restrict the customer. We want customer to abide by. Like we will ask the customer to provide financial statements on a quarterly basis. We need the customer to have fire insurance. Like that, which customer can provide us, customer can adhere to. Here it is a restriction of the customer section. So these two things are called covenants: affirmative or restrictive, positive or negative covenants. Then we come to collateral. There are two schools of thoughts under collateral. They say any lending, we need some sort of collateral. That is a security. It can be a hard security or primary security, or it can be a personal guarantee or a corporate guarantee, like that. Some people say the willingness to pay is the best collateral we can have. If we can capture the cash flow and if the customer has willingness, then you don't need collateral. Right? Those are the two thinking. I showed you this, right? Risk. Collateral, we have 4 types. Stable value collateral with time, This is value. Stable value, like fixed deposit, FDs. Year on year, face value will be the same. Yes, purchasing power may come down, but face value is same. So it is a stable value security. Then you have increasing value security. Land, building. With time, value increases. Then you have decreasing value. Machinery, vehicle. Decreasing value security. Then you have fluctuating value securities. Perishable stocks, high-tech technological stocks, like stock of Apple phones. Their prices changes, right? So, increasing value security, decreasing value security, and stable value security, then the fluctuating value security. Based on the type of facility you are giving, the nature of the risk, you have to decide what is the security you are going to take, right? You are giving a long-term loan by taking a stock mortgage. I don't think it is advisable. When it is a long-term loan, always you should have something like this because risk increases. Short-term loan, yes, you can have this one, no this one, because it is shorter tenor. Right? This is the categorization of collateral. Then we have attributes of collateral, that is the marketability. When we are taking collateral, that collateral, the security, we should be able to sell it easily, right? අපි ගන්න security එක ලේසියෙන් විකුණ ගන්න පුළුවන් වෙන්න ඕන. අපි කියනවා ඈත පැත්තක අක්කර 25කුයි කොළඹ නුගේගොඩ හරි කොහේ හරි තැනක purchase 10කුයි. Same value, which will be able to sell it fast. This 10 purchase one. So marketability අපිට කොච්චර ඉක්මනට විකුණ ගන්න පුළුවන්ද? Accessibility or measurability. ඒ කියන්නේ අපිට valuation එකක් ගන්න පුළුවන්ද? Right? Whether we can take a good valuation. Subjective matters should not be there. Right? When you want to take a valuation, subjective matters should not be there to get a valuation. Like paintings, right? Some people may value painting, some people won't value painting. So it is very difficult to judge a property which has a very artistic value. So that kind of thing should be good for some people, but not for everyone, generally. Then stability. Security value should be stable. If the machine is high-tech and the technology changes fast, then the valuation will not be stable. Transferability. The ability to transfer the property. It is 3 types of transfer. The ownership transfer, අපිට අයිතිය transfer ගන්න පුළුවන් වෙන්න ඕනේ. Usage transfer, අපිට use එක transfer ගන්න පුළුවන් වෙනවා. අපි නිකන් printing machine එකකුයි cement plant එකකුයි ගත්තොත් cement plant එක දෙන්න පුළුවන් කීප දෙනෙක්ට විතරයි. But printing machine එක ගන්න ගොඩක් මිනිස්සු ඉදී. Ownership, usage and then the physical transfer. from one place to another. Cement plant එක ගලවගෙන කොළඹ එන්න බෑ. ඒක එතනම තියෙන්න වෙනවා. But printing machine එක කොළඹ ඉඳන් මාතරට උනත් ගෙනියන්න පුළුවන්. Right? Transferability. Speediness of realization of security. අපිට කොච්චර ඉක්මනට security එක acquire කරලා විකුණ ගන්න පුළුවන්ද? Enforceability. That means some assets we can't take legal action. It is prohibited by government laws or company restricted. සමහර assets වලට අපිට acquire කරන්න බෑ. අපිට ගන්න බෑ. right? එක්ක නීතියෙන් ප්‍රශ්නයක් තියෙනවා නැත්නම් company එකෙන් මේ asset security විදියට දෙන්න බෑ කියලා තියෙනවා. Then absence of encumbrances. පිටින් ආපු ප්‍රශ්න තියෙන්න බෑ. caveat එකක් දාලා තියෙනවා. එහෙම නැත්නම් customer මේ ඉඩමේ කවුරු හරි පදිංචි වෙලා ඉන්නවා. ඒ වගේව තියෙන්න බෑ. You can't have a caveat or some intruder inside the property. Those kind of securities we don't take. Marketability, how easily can we market, sell it? Measurability, how can we take a valuation? There should not be any subjective matters. Stability, valuation, value should be stable. Transferability, ability to transfer the security to someone. Physical ownership and usage. Speediness of realization, අපිට ලේසියෙන්ම පුළුවන් ද මේ ඉඩම විකුණන්න. Enforceability, අපිට පුළුවන් ද මේ අපේ mortgage එක දැන් like currently BOI lands we can't do anything. Absence of encumbrance. Is there any prior party registration or like that? And those are attributes of securities. These are some examples. Then type of securities, we have fixed mortgages and floating mortgages. Fixed mortgages and floating mortgages. Fixed mortgages are when you grant a facility of 10 million, right? You get the mortgage for 10 million. Gradually, you settle the facility. Then the mortgage also finish it off. You can't reuse it for any purpose. It is specific to this 10 million facility. Gradually you repay. At the end of the period, this mortgage also finish. But where floating mortgages are, we say you take a limit of 10 million. You have a facility. Gradually you repay. Now you are around 7 million, right? You need to give another facility of 2 million. He has settled 3 million. So at this moment of time, you can give 3 million without taking another mortgage bond, right? We can refer to this and go ahead with it. So then you go on continuing. Before settling the existing facility, like we forget about this now. Now you settle like this. Before fully settling the facility, you have to give the other facility. Now this will continue. Before settling this one, you need to give the third facility. If the facility in force has settled, you can't use the mortgage bond. Prior to settling the facility, current facility, you need to give the other facility. But at any given time, total exposure of facilities should not be more than 10 million. It will cover only 10 million. Fixed mortgages are, it is fixed for a specific facility. When that facility is finished, mortgage is over. But floating mortgages are when you have approve a facility, mortgage bond is for that amount. Before the settlement of the subject facility, you need to start the second facility. Right? Like that, prior to ending a facility, you can give another facility, but up to the maximum of 10 million if the mortgage bond is 10 million. Apita fixed mortgages වලදී loan එක දීලා ඒක ගෙවිලා ඉවර වෙනකොට ඒ mortgage bond එකත් ඉවරයි. Floating mortgage එකේදී අපි දුන්න loan එක ඉවර වෙන්න ඉස්සෙල්ලා ඒ bond එකම පාවිච්චි කරලා ආපහු loan එකක් දෙන්න පුළුවන්. හැබැයි උපරිම යන්න පුළුවන් අර initially දුන්න loan එකේ ගාන තමයි exposure එක ගන්න පුළුවන්. right? Why we need documents? Because it is the only proof that we have given a facility. So different loan products will have different documents. Like pledge loan will have pledge agreement, working capital loans will have tripartite agreements, like that, different. Then based on the borrower's type, you have to decide who can sign, what are the signatures you need, what are the stamps you need, all those things you have to decide. Any defects in security documentation will create problems to the bank. Pricing, when we talk about a loan price, it takes 4 items. Those are cost of funds, because we have to borrow money from treasury, so we have to pay for that borrowing money. Then loan administration, evaluation, that part. Then the risk premium, that is the credit risk premium of the loan, and some profits. So adding together, it is the sheet rate or the minimum lending rate. Interest rate policies, we have fixed interest rates and variable interest rates. Fixed rate for the tenor rate is fixed, or for a specific period rate is fixed. අපේ market rates වැඩි වුණත් අඩු වුණත් අර rate එක හැමමයි. Right? Variable rates are time to time you change the rate. So you can peg the variable rate to AWPLR, average prime lending rate. Right? AWPLR plus 3. Quarterly change. AWPLR plus AWPLR every 3 months you change. So the customer on lending rate change. Apita fixed rate දෙන්නත් පුළුවන්, variable rate දෙන්නත් පුළුවන්. Fixed rate එකකදී period එකටම fix කරගන්න පුළුවන්, යම් period එකකට fix කරන්න පුළුවන්. Fixed variable rate එකේදී අපි AWPLR වගේ එක link කරලා තිබ්බොත් මාස 3න් 3ට AWPLR එක වෙනස් වෙලා නම් on lending rate එකත් වෙනස් වෙනවා. Right. So that ends the second lecture. We can take a break. It's 2 minutes to 3. We will come by 3:15, maximum by 3:20. We will start sharply by 3:20. 15 is the best if you can't, but 3:20 I am starting, so be there by that time. You have any questions to ask? Okay. What about the legal side when the loan turn to NPL? Yes. It is a different topic. Not today. I think you have a legal aspect on this subject. Your syllabus
Sir, I'm
covers the
asking.
but you are
Sir, I'm
what
asking
I ask,
about the floating mortgages.
yeah, anything when it is NPL, you can go for legal action. When a facility, even a single facility goes to arrears, you can take the floating mortgage for legal action. If it is exposure is more than uh, 5 million, you can go for parate. If it is not, third party mortgages.
It means
Am I
even
answering?
in floating.
Yeah.
Yes, sir. But I mean, even in floating mortgage, from
Yeah.
one facility to another facility, we have to get new bond, I think.
No, you don't need to get a new bond. You can refer the bond to the offer letter. You don't
Right.
need to go and
From
register it in the land registry. We have a bond.
yes.
We refer the bond on the offer letter and sign.
Right, sir. Thank you.
Okay, right. So we'll stop here now. We'll meet at 3:15, max by 3:20. Right? 3:15 is better. If there is no other questions. Okay, some has not come yet, so we will wait for 2 minutes.
So until that time, can I have a question, please?
Yes, sure. Kim.
Sir, as you said, if as an example, we'll say we have a mortgage bond of 10 million, where we have finance against same. We'll say the facility has been settled in full, and is requesting for another facility. Can't we utilize the same mortgage bond?
You can't.
You can't,
Before finishing the last rupee, you have to use go for the second one.
Right. Okay.
Right? ඉවර වුණාට පස්සේ බෑ.
Even so, like even give within a we'll say acceptable period, you can't do it. Right?
No, you can't. I tried this very recently. Legal said no.
Legal said no. Yeah.
Yeah.
Right.
Right?
Thank you.
Okay. Asanga Samir, are you there? Asanga? Asanga, are you there? Right, Asanga, are you there? Asanga innawada? Is not there, but there's a question. Can you explain secondary mortgage? Right? It is like this. It is the timeline. We say we do a mortgage, first mortgage in 2017. So that is called the primary. Then 2018 you do another one, then it is secondary. Based on the time, which is the first one, this is the secondary mortgage. First mortgage is the primary, then the secondary mortgage. Bank 1. Bank 2. Right? The customer goes to another bank and give a mortgage here. It is the first mortgage for this bank. But when it comes to the land registry, same land is mortgaged to bank 1. So even though this is primary to this bank, this is gone as a secondary mortgage on the land registry. Right? So this gets priority. If bank 2 wants to take legal action for this, they will have to settle this one, then only whatever left over can be used by them. Right? If the primary, secondary, tertiary like that, on the same bank, there is no difference between primary, secondary or tertiary because it is the same bank. Primary concurrent is means both banks has the same rights. Right? It is in line with the same mortgage. So that is called primary concurrent. The primary secondary comes on the registration in the land registry. Right? Yeah. Now we'll go to the handout 3. Under handout 3, what I'm going to explain here. Right? Here, what I'm going to explain is why you need to gather information, what kind of information, why you need to have an interview, and why you need to go for site visit, and what to look at in a site visit. Right? That is my purpose of the third lecture. Okay. So when we are having a discussion in the origination stage of a business, when I'm talking about SME, it can be a smaller grocery to a big 100 people company. It's the SME is a range, small and medium. Okay, so our initial discussion is to gather information to find out the strengths of the customer and the weaknesses of the customer. That is the aim of evaluation. So that's in order to do that, you need to gather information. Right? Again, when you are discussing a business, when you are visiting a customer, when you are collecting information, your aim is to fill the P&L and the balance sheet of a customer. We call the balance sheet as financial position, which is done for a day, and P&L as the financial performance of a company, which is for a period. The balance sheet and P&L is the words we used earlier. After IFRS 9, we use the financial position and financial performance as P&L and balance sheet. Right? That's the two words. So you can clearly see the board. I stopped presenting mode. Can you clearly see the board?
Yes, sir.
Okay. So if you have any questions, you can ask me in Sinhala as well, right? Don't worry about it. Right. See, any business, what is our first question? Our first question has to be, what are you doing? What is your business? Why we need this? This is to establish our turnover. Right? Can you see this line? Right? Turnover, which is equal to price into quantity. Right? So it can be a product mix. So N equals 1 to capital N. There can be several products. I'm selling telephones. I'm selling washing machines. I'm selling refrigerators. I'm selling TVs. So there will be several products, average price and average quantity. So that is turnover. Okay. So establishing turnover is the first requirement. When you establish the turnover, your second question is how you are selling. Cash, what is the percentage of sales through cash? And what is the percentage of sales through credit? What is the credit sales percentage? Right? Then this credit can be divided into bill to bill and post-dated checks. Right? So you are laying out the turnover now. And once you know the percentage of credit sales, you need to ask the period. Right? You need to know the period. This is called TOT, terms of trade. කොහොමද අපි විකුණන්නේ? මොනවද අපි විකුණන්නේ? කොහොමද අපි විකුණන්නේ? Right? It's terms of trade. Bill to bill. Because if you are into SME business, you need to know the words SME people or the business people will use. If you don't know those names, you will not be in a position to get ideas from them. Right? You have to be a good listener to SMEs. Bill to bill means I am selling, I go to a shop, sell these pens, 500 units of these pens I give to the customer. He says, I don't have cash, I don't have a check. Then I get him to sign on my bill, come back. After 2 weeks, I go back to the shop and ask for my previous bills money. When he pays me the previous bill's money, I will give him another lot of pence. Right? So always there is money due for me or for a bill. So it is bill to bill. If he does not pay my previous bill, I will not give him goods. That's called bill to bill. Post-dated checks. What is the word we use in the normal day-to-day business? Business people does not use this post-dated check. They use date check. So you need to know what is date check, what is bill to bill. So this is the turnover and this is TOT. And when you are discussing with a customer, you need to remember everything, because first what we'll do, we'll discuss the business with the customer. We collect information, we do the visit, then we will work out the numbers. When you work out the numbers, he may say one thing, and when we working out the numbers, it shows a different picture. So these are checking points whether he is telling us truth or does he know the business. Right? So SME evaluation is a chain, and each point is a link on this chain. ඒකත් අපි මේ කස්ටමර් කෙනෙක් කියනකොට හරියට ඒවා ටික අහගෙන ඉන්න ඕනේ, තර්ක කරන්නේ නැතුව අහගන්න. ඊළඟට ડોකියුමන්ට්ස් ටික අරගෙන විසිට් එක ගිහිල්ලා ඇවිල්ලා ෆිගර්ස් වර්ක් අවුට් කරනකොට අර කියපු එකයි මේකයි වෙනස් වෙනවා නම් you have to ask, right? Otherwise you can't. These are checking points. එකෙන් එක check කර කර යන්න ඕනේ. So you have the turnover. Then you have, if we say A, then you have, okay, turnover, right? How are we going to sell? Turnover comes from few methods. My own shop, my own distribution, through agent, supplier to a corporate or third party. These are the only mechanisms we can sell, right? See, my own shop, I will get cash mainly, or PDCs. My own distribution, we will get PDCs, cash, small amount. Through distribution, it is purely PDCs. Then you have PDCs and GRNs. What is a GRN? GRN is an invoice issued by the buyer saying that they have received goods. GRNs are of two types. First one, they just take the goods in without checking the goods. The quality checking. That is little dangerous. They can return anything at any time. Then other thing, they check and take it in. Then normally they don't return. Right? Those are the two types of products. So by taking these items to your hand, bank custody, you can capture the cash flows. You can capture the turnover, right? So this is the method of selling, and these are the methods of cash or post-dated cash flow. By taking over these PDCs or GRNs, money has to come to your bank. This is turnover. Right. I'll do the P&L and balance sheet now. If this is A, then you have direct cost, right? Direct cost is the cost related to quantity. It is the cost which will change with the number of units you sell or produce or sell. That's the cost which changes directly with the quantity. Basically, we have three items: raw material, labor, power or electricity. We term these three together as cost of goods sold. Always you need to find out these three separately. Right? Then we have gross profit. That is, if this is B, it's equal to C equals A minus B. Right? That's gross profit. Then, after the gross profit, you have overheads. That is, the funds we need to, the cost we need to incur whether you sell or not, whether you produce or not. Right? It is like this. You have quantity to produce, you have rupees. Variable cost is like this. Right? With the quantity, your cost increases. But fixed cost, 0, the same, 1,000, the same. Right? That means it does, these costs does not relate to the turnover. Like the security guards payment. Whether you produce or not, you have to pay the security. So that is the overhead. Admin, selling, advertisement cost and all those things. Then finance. Right? These three are called overheads. Right? Any payment you make to the bank over and above interest comes here. Except interest, any payments you make to the bank is finance overhead. Then we have, this is D. Then we have profit before interest and depreciation, which is equal to E C minus D is equal to E. Right? PBI D. Then below PBI, profit before interest and depreciation. Below PBID, we have interest, depreciation. Right? These two together is F. Then operating profit, if it is G, it is equal to E minus F is operating profit. After the operating profit, you have other income, which is equal to H. Then we have net profit. I equals G plus H, right? Other income is any income the business generates out of the main income source. Like if you are evaluating a printing shop, income generated through printing goes here. Income generated by selling the offcuts comes here. If you are evaluating a shirt manufacturer, income generated by selling shirts comes here. Income generated by selling the offcuts comes here, right? So other income is the income generated not from the main line of business, right? Then in normal scenario, this gross profit margin, this is gross profit. If you divide this by A, which is the turnover, then it becomes a margin. PBIG margin is this divided by A. Operating profit margin is G divided by A. Net profit margin is I divided by A. Right? In normal scenario, this gross profit margin changes in very narrow band. That means if the gross profit margin is 20 in 1 year, another year it can be 21 and another year it can be 19. It normally does not change on this 20, 25, 15, big range. It won't change normally. Why? Any changes in these three items, can be passed to the customer through price. Goes like that. Goes like that. Right? Any changes in these three items only, direct cost, any change in the direct cost can be passed to the customer through the price. Why? Look at a scenario. I'm a baker. My flour price goes up. So all the bakers' flour price goes up. So everyone will increase the price. Right? If the labor price goes up, entire population of bakers, labor goes up, price increases. If the electricity price goes up, everyone will be affected and price increases, it goes out. So always year on year, gross profit margin remains same. Right? But in two instances, gross profit margin changes rapidly. What are those two instances? When the product mix changes. 1 year, I sell telephones. Another year, I sell TVs. So the margins are different. In that scenario, this changes. Second scenario is, I will absorb the cost increase, assuming I will not increase my price, all others will increase, then customers will come to me instead of others. We call it a killer strategy. මම price එක වැඩි කරන්නේ මම පාඩුව විඳ ගන්නවා. මම අඩු price එකට වික්කාම වැඩි quantity එකක් විකුණලා මගේ ලාභය වැඩි කරගන්න පුළුවන් වෙයි කියලා හිතනවා. එතකොට මේක ලොකුවට වෙනස් වෙනවා. එහෙම නැත්නම් product mix එක වෙනස් වුණාම මේක වෙනස් වෙනවා. එතකොට ඔයගොල්ලෝ දැන් customer එක කතා කරනකොට හරි එහෙම නැත්නම් ගිහිල්ලා customer හම්බ වෙලා visit කරනකොට හරි මෙන්න මේවා ටිකට අවශ්‍ය තොරතුරු තමයි අපි ලබා ගන්නෙ. light bill කීයක් විතර වෙයිද? මාසෙකට raw material කොච්චර විතර යනවද? marketing වලට කවුද ඉන්නේ? ඒගොල්ලොන්ට commission ගෙවන්නේ කොහොමද? factory manager කීයක් විතර ගෙවනවා? ඒ හැම දෙයක්ම මෙතන තියෙනවා. අපේ සාකච්ඡාව යන්නේ මේක හරහා. So this is the P&L. Then we go to the balance sheet, financial performance, position of a company. Balance sheet, fixed assets, any asset which has a useful life more than 12 months is a fixed asset. Any asset which has a useful life more than 12 months. Land, building, machinery, equipment, vehicles, work in progress, gross fixed assets. අපි මේ ටික ඔක්කොම ගන්නේ at cost. We are looking at a business and he says, I got my land from my grandfather, inherited land. If you put the land market value here, you will have a big balance sheet. ඔගොල්ලෝ මෙතන ගන්න ඕනේ එයාට මේ land එක ගන්න කොච්චර මුදලක් ගියාද කියන එකයි. right? මේක ගන්නකොට ගොඩක් වෙලාවට අපි deed value එක තමයි පාවිච්චි කරන්නේ. Inherited properties වල deed value එක දාන්න බැරි වෙයි මොකද පොඩි ගණන් තමයි ඒ කාලේ තිබිලා තියෙන්නේ. එහෙම වුණොත් maybe market value again 10 to 25% you can consider here, not more than that. Right? You have a land which is 1 acre. But you want to build a shop? It is 10 purchase. So value of this 10 purchase only should come here, not the entire land value. Then comes the building. We should have an idea about the building cost. If it is a warehouse, what kind of cost we are looking at? If it is a building with tile floor, what kind of a cost we are looking at? 252 354 warehouse. 4,000 to 6,000 for general building, maybe 6,500, depending on the area and all, you can have this. So based on that, you need to have an idea about the land, building. Then machinery. Machinery are the main machines which you need to run the business. For a garment factory, all the sewing machines are machinery, right? Computers, telephones, calculators, all those things goes as equipment. Vehicles are vehicles. Work in progress. Yeah. Any question? Right. Work in progress here represent partly completed buildings, partly completed machinery, or stocks you have brought in for the construction of these items. Right? You are not going to put the steel stocks or sand stock in the inventory. It is work in progress, because inventory is only stocks we are using for day-to-day operation business. After the gross fixed asset, we have less accumulated depreciation. P&L එකේ අවුරුද්දකට තමයි depreciation එක දාන්නේ. මේක අවුරුදු වලට එක වෙලා එන depreciation එක. මේකේ වෙනස net fixed assets. If this is A, this is B, this is C, is equal A minus B. So visit එකේදී අපි මේ ඔක්කොම විස්තර ටික ගන්න ඕනේ. මේ ඔක්කොම විස්තර ටික ගන්න ඕනේ. ડોකියුමන්ට්ස් උත් ගන්න ඕනේ. විසිට් එකේදී මේ හැමදේම බලන්නත් ඕනේ. අයි අපි ඒක කරන්නේ අපිට බැලන්ස් ෂීට් එක හදාගන්න idea එකක් ඕනේ හන්දයි. Right? Then we go to the other asset category, which is current assets. Any asset which can be converted to cash within 12 months is a current asset. අපිට මාස 12ක් ඇතුළත සල්ලි බවට පරිවර්තනය කරගන්න පුළුවන් ඕනම asset එකක් current asset එකක් විදිහට ගන්නවා. Current asset starts with inventory. එහෙම නැත්නම් stocks. Then we have debtors. අපි ක්‍රෙඩිට් සේල් එකක් කරනවා නම් අපිට ණයට වික්ක අය ටික ඒ ටික තමයි debtors කියන්නේ. ඊට පස්සේ අයිතිකාරයා බිස්නස් එකෙන් සල්ලි ටිකක් අරගෙන තිබ්බනම් ඩිරෙක්ටර්ස් ලාට මොන හරි ලෝන් එකක් දීලා තිබ්බනම් මෙතනට එනවා. If you have made an advance payment to purchase raw material, it will come here. If you have given staff loans, it will come here. Any asset which can be converted to cash within 12 months period is fixed current asset. මෙම ගිහිල්ලා cash තමයි අන්තිම එක current assets වල. Last one on the current assets is this. Then you have current liabilities. Any liability which needs to be settled within 12 months period is called current liabilities. Make ඉස්සෙල්ලාම ඉන්නේ creditors. Right? ඒ කියන්නේ අපි market එකෙන් ණයට ගත්ත බඩු. Right? අපිට අපේ shareholder කෙනෙක් සල්ලි ටිකක් දීලා තිබ්බනම් ඒක එන්නේ මෙතන. අපිට අවුරුද්දක් ඇතුළත ගෙවන්න තියෙන වගකීම් තමයි මේකේ දාන්නේ. If you have not paid the EPF, ETF, then it comes as accrued expenses. Whatever the liability we need to settle within 12 months period comes here. So it goes on and it ends with short-term loans and ODs, right? Then net current assets or current liabilities, which is D, E, F. This is equal to D minus E. After that, you have total assets, which is equal to C plus F. This is current total assets. Then the other part of the balance sheet is finance by share capital, reserves, net worth, term loans and leases, total capital employed, right? If this is total assets, if it is G, if this is H and this is I, this one J equals H plus I, H plus I. G should be equal to J. Balance sheet balance sheet. This part, net worth, or this part is called equity capital. This part is called debt capital. Right? Equity capital and debt capital. The word share capital, net worth, we normally use only for limited liability companies. For sole proprietorships and partnerships, we don't use the word share capital, net worth. We use owner's capital for partnership, sole proprietorships, and partner's capital for partnerships. These two words are used only for limited liability companies, right? So on your visit and discussion, your aim is to fill this entire thing, right? So we need the P&L balance sheet from next week onward, because we will be discussing the financial evaluation, right? For financial evaluation, you need to be thorough with these two. Okay. Any questions on this? P&L and balance sheet preparation? Because you have to be very thorough with these two. I can spend another 1 or 2 minutes to explain anything if you have any questions. No questions? Can I proceed? Right. No answers, no questions. I'm going to proceed. Right? Objective in gathering the analyzing info, determining strong points, recognizing the weaknesses, which are more critical factors. Then, in order to get the correct decision, you need to gather information as much as possible on a customer. Then out of those information, you need to know which are the correct ones and which are the critical ones. Then you analyze those information to find the meaning. Analyze and interpret in the meaning of the information. It's not good just to have information. You have to find the critical information, analyze it, and find the meaning. Then it is not only once you do the evaluation, you need to repeat it. That is the monitoring part. Evaluation, I showed you pre-sanction and post-sanction. So gathering information is a process from the day one to the last day of settlement. Then we come to source of information. Customer himself, the application he fills, the requirement he tells us, that is the first source of information. Then financial statements they give, the P&L and the balance sheet. Right? P&L and the balance sheet. If they give a project report, business plan, bank statement, bank records, bank references, crib report, traders associations information, credit reports, all those things will give you different information. Then informal sources. You need to speak to the employees of the company or the business, suppliers, buyers. If a supplier says, I'm supplying him, he's very bad on payment, I'm supplying since I need to get my money, that's not a good sign. If an employee says a bad word, that is not a good sign. If a customer says, I'm buying this product because I don't have alternative, that's not a good sign. Because banking relationship is for a longer period. Then any indication we should get out of it. Right? Even competitors telling bad words about a customer, you have to be mindful. Competitors will not tell good things about their competitor, but you have to weigh it and take it, right? You can get information from competitors as well. Like you go to a tea factory and he says, this guy is destroying the market. He's just overpaying and taking all the green leaf. What does that indicate? He is not producing good quality tea, right? So his pricing will crash very soon. Right? So you have to interpret the information. Then the accountants, lawyers, and employees. Once I went to a business, big business in Kurunagala. Right? Then story was good. There was a employer, rather a consultant, who was an ex-banker. Then we came back and I wanted my credit team to have a leisure chat with this gentleman. While chatting with him, we found that operation inside is not that good. What they showed is a rosy picture only. So we didn't give the facility. Right? Public reports, media reports, current business information. Interview and inspection. What do you get from the application? Purpose, amount required, borrower's identification, bank information, financial standing, all those things we gather from the application. Then NIC is a NIC or the business registration is a critical factor because we need to get the credit check done. Then the company details, forms, Form 20 and all those things you need to have. Project details, the cost estimates. For a building, you need a BOQ. For a machinery, you need a invoice, pro forma invoice. Then you have to look at the trade license. You have to look at the environmental license, all those things. Tax, yes, better if you have, at least he's paying some sort of tax, is better. Any other documents deemed suitable. Bank statements. When you get the bank statements, you look at different things. On the current account, it is the cash management. On the savings account, it is the savings habit. On the facility details account, facility account, that is the repayment history. Right? Current account is a mirror. It shows monthly sales. We say your current account statement shows you only 5 million a month deposits. But when you are talking about terms of trade, he says 80% is on credit. 80% is on credit and I am selling 20 million a month. That means 16 million he gets post-dated checks, some sort of a instrument. So then your current account operation should be more. It may be he thinks he is getting 20 billion, but he is not getting. Or he may be using the receiving post-dated checks for some other purpose, like just giving and taking the raw material. Or it may be he's not disclosing all the bank statements. He has given us only one bank. He has another bank account, which he has not given. So you have to have this dialogue. Highest lowest value, cash deposit, credit cards, then deposit account, savings habit, then current statement. You can see any standing orders, loan repayments, check returns. So check returns indicate the stability of the cash flow. Right? So all these things can be taken from the current account. Then the crib. It is not only, crib does not indicate only the repayment history, but it will show other banks who has inquired about this customer. So whether he is going on window shopping or all other banks are doing reviews, all those things can be taken from that. Your NIC, business registration, and crib registration numbers and the address, You can double check all those things. Loan installments you can find out, total borrowings, total exposures you can find out. Then the check return history for 24 months is available. All those things can be taken from crib report. Conduct of the facilities, check-in done by others, check returns, and all those. Other reports, these are high-end external credit rating reports, public reports, central bank, traders associations, commerce and EDB, commodity brokers, tea factories. You can get all the details from the commodity broker. Importance of customer interview. Now you get the information. Now you want to interview. Understand the business operation. Because through the statements, you can't have a proper idea. You need to discuss. Then only you will need know the terms of trade. And you need to understand the purpose and amount of credit you need and verify the information we receive. And understand the future potential and the future direction of the business. Before the interview, you have to prepare yourself. Go through the statements, check what are the gray areas, what are the critical factors you need to discuss, and do the interview. Then we have a behavioral aspect. It's not only just an interview. Whether they are punctual, appointment, punctuality. When you are having a casual talk, you can guess his mentality, attitudes, talk about the environment, so you can see whether he is okay in destroying the environment or how he is treating his waste. Always you need to listen to the customer. You have to be a good listener. Discuss the business. You just don't speak about everything except the business. You can't. You gradually come to the business and go into details. But while doing, you need to listen maximum and speak limited. Be a good listener. Don't interrupt. Show that you are a good listener. Do not challenge. Sometimes customers tell you like way out things, but still you listen. But you never argue, but you can propose alternatives. So when you are discussing with the customer, you can give your success stories. Okay, I have seen a business like this. It was happening like this. Without arguing the customer, you can show the success stories. You have to be tactful. That is to find out the weaknesses of the business, purpose, any hidden agendas. In order to find all those things, you need to be tactful. You have to use your experience. Discuss his real requirement. Look at the change in technology, international trade. If today you go to a PETA customer, you will have to speak about everything, China, then trade business, market trends. So you need your exposure. All those things are just reading material, time management, keep down note. Other thing is, whenever you are asking for information, ask it at once. Whenever customer calls, don't just ask one, forget about it. When he calls again, you ask another question. Don't do it. Understand the business, evaluate, get the total requirement, and then speak to the customer. Inspection, that is only if you are satisfied with the interview, you go for the inspection. Inspection, again, you have two things: existing business and new business. Go through all the corrected information. Make sure you know what are to look at. Prepare the questions, or be ready with questions, because you know that you need to prepare the P&L and the balance sheet. You have received some information. You have done an interview. Then now you are going to see the production line or the sales line. So you have to check what is on the documents, what he disclosed, and what actually there on the flow, right? Check the name board of the business and the address. You have to check it with the business registration, right? Very recently, I had a issue. My team went to a customer. Then he has shown us a wholesale shop. He was in that. Then they came back, right? But his business registration was different. There was a name and a different address. When I asked them whether you saw the business name or the name board, they have not seen. He has shown something which maybe it is not his own thing, right? So when you are going, you have to take the address verification thing and the plan with you always. Plan is to check your security. Address verification is to know whether you are going to the same place where he is doing the business. But you have to be very tactful. You should not show that you are checking this, right? But you have to check without showing. You should never show the customer you suspect him, but you should suspect him. Check the asset and liability, check the level of operation, asset position, land, building, plant and machinery, what we did earlier. Just look at the condition. Yes, there is a building, but it is bad condition. Then value has to be lower. Then you should realize, okay, if he is to operate here, you need to do maintenance. For that, you need money. So all linked to each other. So on documents, everything perfectly okay. But when you go to visit the business, you see the building is bad. So you have different mindset now. Do you need any additional, like building is fully packed? Now he is talking about a machinery to purchase. Can you install in this building? Or do you need to get another space? We gave a long time back. We gave a machine. It is those days, it's what's a 4-color machine, right? It is a good technology at that time. 4-color offset printing machine. They showed us the place. They have enough space. We went in, we brought the machine. Then to see that space is not enough for the machine. So they had to construct a building, which was not planned earlier. So all the working capital funds went for that. So after installing, they didn't have enough money to run the business, right? So you have to look at the fixed assets. Then the current assets, inventory. raw material, work in progress, finished goods, packing material, all those things you have to see. When I was a credit officer, how long? Long time back, right? We had the rice miller, small scale rice miller. When we went in, he showed us paddy. We checked paddy, paddy was there, right? Then after a year or so, he went bad. Even we had to auction his house. Then we asked him what happened. Then he told, when you came, I didn't have paddy. I didn't have paddy. So what I showed you was paddy husk covered with paddy. Right? So all those things happening. So you have to check properly. Right? Then debtors. How he has declared, I have debtors like this. If you can check the books and all, that's better. Right? Current liabilities, again, creditor. Signals of over trading. Larger investments, larger debtors, no stocks, like that. Level of operations, production, whether when you go to business, whether the operation is happening, right? Do you have finished goods? Do you have raw materials? Do you have enough manpower? Then do you have enough power, basically? I had a polythene bag manufacturer. He was operating in Maharagama. Then he shifted to somewhere in Horana, I think. Right? Little deep inside Horana. I went to see. He shifted, but he couldn't start the operation properly. I went to see that place. Then to realize that his transformer is almost a kilometer away from his factory. Then I asked him why. But why are you not operating properly? Then he said, when he starts the machines, power drops. Right? So neighbors complain. So he can't start the machines because transformer is 1 kilometer away. They need to bring it closer. For that, he needed 2.5 million or so. Right? So because of that, he's stuck. Why you shifted from Maharagama? It was a rented out place. This is free space he has given me. Right? So all those things, when you visit, you need to ask power. When you have lot of machines, you have to see whether there is a transformer. All those things you have to see. Potential for expansion, adequate space availability, those things. When you go to new projects, you have to look at location, fixed assets, availability of utilities. Location, access to the site. Based on the project, whether you need to have a 20-footer container or a big lorry or a 40-footer container, based on this, you have to see whether it is possible. I wanted to finance a garment factory. They had selected the area where you can't take a 40-footer easily. You have to reverse the one and you can't turn. So we inform him, this is not suitable. Location, access roads, ability to transport the raw material, labor. Other thing is labor availability. There are tea factories where factory is there, everything is there, workers are not there. Why? No labor. So you have to bring them from Hatton or Talawakale or somewhere from there, give all accommodation, food and everything, and keep the labor in order to operate the factory. So location should be suitable when you have enough labor as well. Environmental stability, suitability. If you have a plant where you need a lot of water, see whether you can dispose your waste environment. Then goes to land again, extend, development requirements, soil, all those things they have to look at. Because your aim is to build the P&L and balance sheet as well as the project cost. So project cost include all those things. Building, nature of building, flow, construction, utilities, power, all those things. Whether it is enough space for current production and future, machinery, make, model, the capacity you have, prices, all those things you need to have. Vehicles, based on whether it is your own vehicles or whether it is leased out vehicles, whether it is operating leases, what are the vehicles you have? Are they old vehicles? Then you have a maintenance issues, all those things. Other fixed asset, furniture, computers and those things. Utility is the power, water. So whenever you have power, grid power, do you have generator for supporting power? Because some productions you can't stop, you have to continue. So in that case, if the power drops or power failure comes in, there has to be another alternative way of finding power. So in inventory, when you have current assets, you have to look at the inventory, debtor positions, creditor positions, those evaluations you have to look at. Those are calculations. Workforce, again, labor, number of people, all those things, management team, who is in the business, what are their capabilities, what are their education qualifications, what are their experiences. Because end of the day, everything depends on the management team. Production process, install capacity and utilize capacity. Install capacity is what is the maximum amount of production machines can do, plant can do. Utilize capacity is though a machine can do output of 1,000 pieces an hour, due to reasons like startup, machine change, labor change, efficiency, breakups, all those things, only 750 per hour is producing. So 1,000 is your install capacity, but utilized capacity is 75% of that. So whether they have charts, production details, sales statistics, rejections, all those things matter when you are going for evaluation. Right. That is the data collection, interview, and we go for the inspection. So you collect data, do the information, cross-check, then go to the physical side and check. So all those things come as parts, right? Dishan, you are there?
Yes, sir.
Okay. Your question is, please explain liability part. I could not find fixed liabilities.
Yes, sir.
Yeah, liabilities are here. You have current liabilities here. This is short term and TODs. Then you have term loans and leases here. This is long term, more than 12 months repayment. This is less than 12 months repayment. Okay.
Okay, sir.
Right. Right. So this one is very critical for us. So you have to be thorough. I think I should be able to start the finance part now. We have roughly half an hour. Financial analysis, these are, you just look at it. This is what the P&L and balance sheet is. Financial position, fixed assets minus assets minus liabilities, which gives the book value position of the firm. Revenue minus expenses is the performance of a firm. Right? These are the three statements we analyze. Financial position, that's the what is the assets, what is the liabilities for a specific date, which is the balance sheet. Income, it is operations, how the operations happens and what is the revenue and the profits. Then the cash flow statement that shows the cash into the business and cash out to the business. Right? Look at this. On the business, these are the points where you get money into the business. This one, you get money in. This one, you get money in. This one, you get money 1, 2, 3. Right? Then, through creditor, you don't get money, but you delay the use of money. Right? These are the 4 points where money comes to the business. How does this money work? From short term, it goes to cash. Cash goes up. You get a short term loan, cash goes up. You take a TOD, cash goes up. You don't pay creditors, cash remains the same. It will be preserved. Share money comes in, cash goes up. Term loan, cash goes up. When you have cash, what will you do? You go and buy inventory. Then cash comes down. Right? Inventory you sell, so inventory comes down and debtors increases. You collect debtors, so debtors will come down, cash will go up. When you have cash, you will settle creditors. You will settle TODs. Right? Again, you will take TODs. It will come to cash. Cash will come here. Then it will go here. It will come here. Then it will settle here. Here. Right? This is how the cash moves within the company. Right? This is how the cash flows through the business. You have to be thorough with it. Cash comes from this, comes from this, comes from this, and comes. It comes here. From this point, it will go to inventory. Inventory will convert to debtors. Debtors will come to cash. Again, it will settle creditors. It will settle short term. Again, you will take them cash, inventory, like that. It goes. So managing this part is called working capital management, right? Which we will look at it later. So these are three statements. Who needs financial statements is the internal users and external users, right? Why internal users? It is for the use of management purposes, planning purposes, evaluation purposes. For the external users, that is for evaluation purpose. Then we have this horizontal analysis, vertical, common size, trend, and ratio analysis, right? Horizontal analysis is when you are evaluating 2 years of performance, turnover of 1 year is compared with turnover of other year. So horizontally, we are evaluating raw material cost of year 2019 and year 2020. Administration cost of year 2019 and 2020. Across, we are evaluating few years. Vertical evaluation is single financial statement you evaluate vertically. It's like you have turnover, you have gross profit margin. So you represent gross profit as a percentage to the turnover, percentage of a significant total. So gross profit margin is a percentage of total turnover. Net profit margin is a percentage of turnover. So it is, we are considering only 1 year. All items are represented as a percentage of the major item. Common size balance sheet, P&L. Common size means we normally prepare P&L, balance sheet, cash flows on absolute terms, rupee terms. But here when it comes to common size, we don't use rupees. We represent everything as a percentage. If you go to the other handout, this one, see this P&L, you have 3,900, which is the 100%, right? Your cost of goods sold is 3,250, which is divided by 83, it is 390, it is 83%. So this one, this line and this line, that is the common size. We are looking at percentages. We are not looking at rupees and cents, right? Why we need this kind of P&L and balance sheets? To avoid the size difference. What is that? We have a soap manufacturer who has a 300-400 million sale level, and we have Swadeshi Industry or Hemas or Unilever who is into billions. When we want to compare these two, you can't compare because this is few millions, that is billions, right? But if you take percentage, size will be out of the equation. Say 5 billion turnover of Hemas is 100%. 300 million turnover of Starlight is 100%. Right? Gross profit of 200 million, which is 60%. There it is only 1 million, 25%. So we don't consider the time size. We consider everything based on a percentage. Therefore, size difference, take it out. Right? So common size balance sheet or P&L is used to get rid of the size differences. Then you have trend percentage analysis, that is one single item we evaluate over a longer period of time. Turnover, how it has changed over 10 years, 5-year turnover change. One specific item, horizontally we will check. Ratio analysis is relationship in between these items. I'll give you an example. Right. This is the example. Horizontal analysis, you have 2 years, 2019 and 2018. 2018, it was 23,500 cash, and 2019, it was 12,000. Now you are doing a horizontal analysis. So 2019 minus 2018 figure is 11,500, which is a drop. When it goes as a percentage, 12 minus 23 divided by 23 into 100 is 48.9%. So we are evaluating horizontally, line by line. See, the second one, account receivable 40 to 80, 20 million, 20,000 increase. 20 divided by 40, it is 50% positive. Inventory 100,000 has come down to 80,000, negative 20,000. 20 divided by 100, 20%. Right? Like that, you evaluate horizontally. That is horizontal analysis. Then we'll go to, again, the same thing, account receivable. So you can work out this and see P&L, sales, 480 to 520, 40,000, 40,000 divided by 480, it is 8.3% growth. Vertical analysis, the vertical analysis, cash, then accrued expenses, like that you have. So first one is 100, 483 is 100. Accumulated depreciation, negative 17. 17 divided by 483 is minus 7. Minus 4. 110 divided by 483 is 23%. 23% of 100. Always like that. You represent each item as a percentage of the major item in one specific year. You are not doing it horizontally, you are doing it on vertical basis. Same thing. Trend percentage, revenue and expenses. You have net profit of 119, 18, like that. So you are evaluating the revenue trend. From 1820, it has gone to 1991. So the difference is 171. This divided by 180, which is the 171 is 1820, which is 9% growth. See, this 109. So you divide this by this, it is 109. This by this, it is 116. Like that, it has shown a growth from the base year. Base year is 2015. So you have a gradual growth there. So this is the evaluation, right? This is the evaluation. Trend, you see a trend of sales increasing and similarly expenses increasing. Ratios, we can write ratios in 3 ways. Ratio as a 1:2, or you can represent it as a percentage, or it can be in rupees. You need to know, when you are evaluating ratios, you need to know the reasons behind the ratio. Otherwise, you will be in trouble. You have 4 types of ratios. Liquidity ratios. It shows the company's short-term debt paying capacity. Liquid ratio. Equity ratio or sovereign ratio indicates and shows the relationship between long-term debt and long-term bank borrowings and the long-term funding by the equity. Profitability ratios, it shows the profitability of the company, how the turnover has changed, how the profit has changed with operations. Then market test ratio, it gives the market information. These are done only for listed companies and relative merits of the stock. So what we will do under market ratio is we will evaluate a company in the market. Right? Liquid ratios are there where it is the liquidity position. That is liquid ratios are to deal with this part. Solvency ratios are to do with this part. Right? Profitability ratios are to do with P&L. Okay. Market ratios are prepared for quoted companies. We need number of shares, profits, like that. Right. I think I'm done for the day, though I have a half an hour more, because I will not be able to finish. Right. These are the 10 ratios we will be evaluating. Current ratio. Yeah, these are 10 ratios we have. We will be evaluating these ratios. I'll do some ratios and go. Right. So without going through this, I will show you from the board how to do the ratio. Right. Current ratio Current ratio equals current assets divided by current liabilities. That means this one total current assets X, this one is Y, D by E. It is D by E. Right? What does this indicate? Make indicate කරන්නේ current liabilities කොච්චර සැරයක් current assets වලින් cover වෙනවද කියලා. What is the coverage current liabilities has from the current assets? Why do we need this? We say D is 20,000. Current liabilities are 10,000. That means 2:1. Each rupee of current liabilities, we have 2 rupees of current assets. Why? Current liabilities are settled by liquidating current assets. See, inventory converted to debtors, debtors collected cash, cash used to settle these items. Right? So each rupee of current liabilities are covered by 2 rupees of current assets. If in case when you are trying to convert, you are not in a position to collect this money. Right? You have 20,000 here, you get only 15. But still you will cover this. You have 20,000. When you want to convert to cash, you will get only 15,000. If you had only 12,000 up and 10,000 down, when you want to convert it to cash, you get only 8,000 divided by 10. You are not going to settle everything, right? So this shows how much current liabilities are covered by current assets. So in case of a low conversion of current assets into cash, you can pay the current liability holders. That is the liquidity of the business. Why? Current liabilities are settled by liquidating current assets. Current liabilities are settled by liquidating current assets. That is current ratio. Then we have liquidity ratio, quick ratio or acid test, which is equal to current assets minus inventory divided by current liabilities. Inventory is the most hardest to convert to cash. සල්ලි බවට පරිවර්තනය කරන අමාරුම inventory stocks. ඒකන්ද අපි බලනවා inventory ටික අයින් කරලා current liabilities කොච්චර සැරයක් අනික් current assets වලින් cover වෙනවද කියලා. We take out, since the most difficult to convert to cash is inventory, we take out inventory and see how much current liabilities are covered by the remaining current assets. Right? That is acid test or quick ratio. Then we have something called efficiency ratios. Under liquidity ratios, right? There are 3: stock turnover, which is equal to cost of goods sold divided by average stocks or average inventory. What does this mean? Why have I taken cost of goods and average? Whenever you are calculating a ratio using P&L figures and balance sheet figures both. Whenever you are calculating a ratio using P&L figures and balance sheet figures both, you need to take balance sheet figures as average, P&L figures as it is. Why? P&L is for a period, balance sheet is for a day. In order to avoid this timing difference, we use this average figures from balance sheet and same figures from P&L. Stock turnover, cost of goods sold or direct cost divided by average inventory. That means how many times per annum inventory converted to sale. That indicates how many times per annum inventory are sold. How many how many times per annum inventories are converted to sales? No point holding inventory if you can't sell it. So faster, larger the number of conversion to sale, better the cash flows. Stock turnover. Then we have some same thing called stock or inventory turnover period. And that is average inventory divided by cost of goods sold into 365. This is number of days. On average, how many days it will take to convert inventory into sales? On average, how many days it will take to convert inventory into sales? That is stock turnover period or inventory turnover period. Similarly, you have data collection. How many times credit sales divided by average debtors? On average, per annum, how many times we collect our debtors? That is debtor collection, right? If it is number of days, debtor collection period. We need these figures. Huh? Average debtors divided by credit sales into 365. It shows on average how many days you take to collect your debtors. On average, how many days you need to take to collect your debtors. So on the TOT, if you have not asked what is the credit sales percentage, you will be in trouble here. You have to ask it first. Then only you can do it here. Right? So the last one out of this is creditor payment. Cost of goods sold divided by average creditors. How many times per annum you settle your creditors? Similarly, creditor payment period. So it is other way, average creditors divided by cost of goods sold into 365. Right? This is average creditors. This is how many days on average we take to settle our creditors. First one, inventory conversion period. How many days on average we take to convert inventory into sale. Debtor collection period, on average how many days we take to collect our debtors. Creditor payment period, on average how many days we take to settle our creditors. That is creditor period, right? Then you have leverage ratio. So you can go through the handout. Example is there. I am using this board example to show you the figures. That is liquidity ratio. Then we will have gearing ratios. Gearing or leverage ratios. This is to deal with equity capital and debt capital. That is how the business has been funded, right? You can write net worth divided by term loans plus leases. That is equity capital divided by debt capital, right? That means what? If it is, we say equity is 2,000, debt is 1,000, 2:1. That means each rupee of debt, we have 2 rupees of equity, right? Or you can write debt capital divided by total capital employed. If it is 1,000, total capital is 3,000. From this is 3,000. So it is 1/3, which is 33%. Right? So debt is 33%, equity is 67%. This shows the financial risk position, long-term borrowing position of the company. Financial risk position of the company. Right? So we covered a lot today. We discussed the lending principles. Then we went on to discuss interviewing, site visit, documentary collection. All those things we discussed. Then P&L and balance sheet, which is the foundation for future lectures. I did it. Then these are the ratios we needed. Right? So ratios we started. We did the liquidity ratio and gearing ratios or the leverage ratios. Next week we will finish the profitability ratios and the market test. Market test is not required for SME, but let me do it and we'll go to the other parts, right? So because you need to do a project, I need you to know these things properly. Otherwise, on hand, you are not in a position to do, right? Okay, thank you very much. If you have any questions, I can answer you. Okay, no questions. Thank you.